Portfolio Builder members, welcome to our webinar. I've unmuted everybody so we could chat a little bit while our crowd continues to join the webinar. Harry, Kirk, how's it going?
Good.
You added some couple lots of 100 shares to your portfolio today, is that right?
Yeah, I did. I added a couple of hundred shares of Microsoft and 100 shares of Comcast.
Nice.
Oh, I'm sorry, not Comcast, Cisco.
Okay, cool. Now, were you able to figure out how to input that into your spreadsheet, or would you like me to help you with that after the webinar?
Yeah, I'd like for you to help me. I've been traveling this morning, so I haven't had time to really look at it. So.
No problem, but I'll give you a call after the webinar, and we can I'll help you input those, and it'll only take a couple minutes.
Okay, thanks.
Jerry, what's going on over there, buddy? I guess he doesn't have his audio on yet. Let's see, a couple more people joining. Bob, welcome. A bunch of new names piling in here. Welcome, everybody. We'll have our mics on just to kind of say hi for a few minutes here, and then we will mute it, and I'll go into a presentation. Some of our normal attendees are getting too used to the trades. They already know how to do it and aren't coming on to chat with us on the newbie webinar anymore. So, Mark, you out there?
Yes, can you hear me?
Yeah, I can hear you a little bit.
Yeah, my mic is, I don't know why my mic doesn't work too well.
Oh, nice. Okay, I can hear you now.
Is that better?
Very good. Let's see, we got more people coming in here. I'll start us up in a few minutes. So you're following the diamond trades now, Mark?
I am, yes.
Nice. Welcome, S Moon 644 just joined. Yeah, I guess I don't see an audio for him. Bob, how's it going? The AJ Bates, how are you doing? Do you have your mic? We've got another guy who came in as a free trial. Vicente from welcome.
My mic's on. I just wanted to say hi, Jason. It's Jerry.
Hey, Jerry, how's it going, buddy?
Good, thanks.
Yeah, the darn video yesterday was great, and I managed to mute the second half of it, so I apologize. Luckily, the important information was covered in the first 9 minutes, so didn't miss out on too much if anyone else noticed that. All right, guys. Well, people keep coming in. I will go ahead and mute it up and get this show on the road here. And I'll open the mic back up so we can all chat later if we have any specific questions. All right, let's go ahead and get started. Welcome, everyone. Today we will review our past week of trade alerts, as well as the 3 track records, and what our look into the future is in terms of how we're going to be playing these markets. The general theme is to play it safe because of the escalation in the trade war. So a quick review, we do have 3 portfolios. One is published Monday, Wednesday, Friday at noon Eastern, which is called our basic program. It specializes in primarily trading the SPY ETF, and it does that by purchasing lots of 100 shares of the SPY and then selling covered calls. Now, when market risks are high, we like to sell the in-the-money covered call. This is the only way you can profit from a up, sideways, or down move in the stock market and not get killed predicting that the market may go down, and it does not. And so we'll go over that in great detail. But this is a trade that takes advantage of 3 option expirations per week, Monday, Wednesday, Friday. It's the #1 security in the world, $16 billion a day on average of trading volume. And its options market also dominates trading volume compared to all other stocks and ETFs, as well as it's the only security with 3 option expirations per week. Now it does have unique times where it will rotate from the SPY into these growth ETFs, which are the QQQ, the EEM, EWJ, VGK, and ASEA. But that's only when volatility has spiked very high, well over 30, and these stocks are at a discount. Also, we'll be able to write very deep in the money covered calls on a weekly basis to protect those positions. So if you do look at our track record, you can see that we did that for a brief period of time during the Christmas massacre, and then rotated back into the SPY once the cost of equities got relatively expensive again. The next class we have is our diamond level program. It's looking at what the SPY ETF actually purchases, and it's removed some of the stocks that are too expensive for most investors. So it's pulled out Amazon, Google, and Berkshire, which would cost over $100,000 per security to own 100. And our strategy requires that you have at least 100 shares of each security so that you can write one covered call. The covered call is our main instrument for protecting capital and generating profits. So this portfolio is holding a 21% allocation in Microsoft, 10% in Apple and Facebook, and then around 2.5% to 5% in Intel, Cisco, and Comcast, then has large positions in Bank of America and Wells Fargo. Now, the difference has been about 1% a month average return, sometimes higher, in our basic program with lots of protection as well, and then around 2% a month return in our diamond program. And so the big advantage with the diamond program is that by removing the cushion that the SPY ETF provides, you have a little bit more risk. So these individual securities are more volatile than the SPY is. And because of that, the covered call strategy generates a higher yield. The call option market is more expensive when we sell these calls on the individual securities versus using the SPY ETF, which represents 500 companies. Now, the big benefit here is that these companies are leading the market. They have the most capital inflows from the SPY, QQQ, and other similar ETFs. They have the largest market caps. They have the most profitability. They have the best credit ratings. So they're able to put the most money into stock buybacks, which has been the key to the market rally this year. Now, this program only trades on Tuesday, and it has generated these profits primarily from writing in the money covered calls. So if we'd been a little more bullish and had written at the money or out of the money covered calls, then this portfolio could have been even more profitable. But now that we're headed towards a Cold War with China, the plan is to continue to write these in the money covered calls so that we have a safety net week over week. The final class we teach is the whale portfolio, and it's a little bit different in terms of portfolio size as well as the sophistication. So while the basic program and diamond program are going to immediately jump into equities and ride the wave, the whale program is a little more patient, and it will spend the bulk of its time trading either the long treasury position or the short treasury position. And the reason we do this is because there's not a lot of volatility in treasury rates, so it makes it very stable to do a covered call strategy. So this portfolio has been sitting on the TLT position the entire time, and it's waiting patiently to rotate into this group of stocks: Microsoft, Apple, Amazon, Google, and Facebook. And to build the portfolio in the right allocation size, you're going to need about $1 million. Otherwise, you're going to be too heavily invested in Google and Amazon. So if you're sitting on an account size that's between 150 and up to $1 million, you may be better off with the Diamond program because it has removed the Apple and Google positions. However, if you are sitting on a 7-figure portfolio, you don't like losses, you like low volatility, and you're very patient, that's where our whale program really comes into play. Now, what I'd like to do next is highlight our crypto portfolio. This is a bonus that comes with all 3 products, and it should only represent at most 5% of your total portfolio. So this part of our portfolio has actually almost doubled. It's up 75%, so it will be time to take some profits into cash. And our plan for this is to carefully look at the rush out of Chinese currencies as they devalue the yuan to try to offset the cost of these tariffs. So that's what I believe is pushing a lot of money into Bitcoin right now. And as long as this trade war continues to escalate and there's a fear of additional tariffs, I believe that Bitcoin does have some more room to go. So the profits from this portfolio are not flowed into this program as they're completely different. A lot of our people don't want to touch crypto in general, so that's totally optional. But this is a very exciting market that we're playing with a very simple portfolio. So we'll be looking at when to take profits by selling half of our cryptocurrency portfolio. Then we'll be trying to call a top in this market and then eventually looking for a short opportunity. So that's kind of what we have coming up for the Bitcoin. And we'll take a look at some of the indicators I'm watching to try to determine when we're going to be getting near a top in Bitcoin. What I have now is the past week of trade alerts going all the way back to last Monday. So this would be a typical trade alert for our basic program, which trades the SPY. And so we summarized the trades up top, showed what the potential return could be if we continue to make these profits. And it's important to point out we're not going for big gains. So you can see in this trailer, we had a return of 29 basis points, so 1/3%. And if you can pull that kind of profit from selling a covered call that's in the money with protection, it really adds up over time. And so this is a compounding calculator that says if we can generate a $156 profit per contract, each contract represents 100 shares of the SPY. So that does cost less than $30,000. I just rounded it up to keep life simple. But if we can pull that type of return 3 times a week, 52 weeks a year, that's over 100% return per year. Now I'll tell you right off the bat, we're actually aiming for much less than that, closer to $50 a contract. But when volatility spikes, our cost to sell these call options becomes incrementally more profitable. So we actually saw the cost of call options quadruple during the last small volatility spike when the threat of trade wars started to escalate. So again, this is not the type of return we're going for often, and it may seem small on its own, but when you do this consistently 3 times a week, 52 weeks a year, it allows you to protect your capital and generate a very consistent return regardless of market direction. And so this strategy actually does better the more volatile the stock market becomes. So if the stocks are just going up nice and smooth sailing, the cost to buy call options becomes cheaper and cheaper. And so most of this year, we've been in an environment where it's not that exciting to sell call options. And just in the last few weeks, during the most recent stir up in the stock market, have the option premiums really spiked. And the good news for us is that it looks like there's no end in sight to this trade war. So there should be plenty of volatility spikes all year to take advantage of. Now, this is just a comparison of the Friday profit loss to the Monday profit loss after covering our SPY position. So almost always we will report the earnings after we've bought back the most recent covered call and before we've written the new one. And that's because oftentimes when I sell an in the money covered call, the second I do that, it's going to inflate the reported return on income. It's only when we sell an out of the money covered call that it really won't inflate our return and is very close to what our profit will look like in the next period. So this was our Monday trade. Tuesday, we delivered our diamond level portfolio, and you can see this is, again, getting rid of the SPY ETF. We can get a better yield, and we can aim our covered call at different price levels based on each individual security. So this week, for example, and actually the last few weeks, we've been relatively precautious in the tech sector due to the threat of the US-China trade war, and more bullish on the banking stocks, which have been lagging versus their tech peers. And so again, this portfolio does cost more to purchase, but when you do, you have a very similar risk profile to the SPY ETF, except you've removed, obviously, all but 8 of the companies. So these are the 8 leading companies in the SPY and the QQQ that already get most of the capital flows from these ETFs. So they have a huge demand from those SPY ETFs. They're also the leaders in corporate buybacks, which has been the biggest buyer of stocks last year and this year. We're now sitting on a record amount of stock buybacks. And because they have the best credit ratings, they can borrow all the money in the world that they need and continue this corporate buyback strategy. So the typical trade alert for this program starts you off with purchasing 300 shares of Microsoft, 100 of Apple, Facebook, Intel, and Cisco, 200 of Comcast, 900 of Bank of America, and 500 of Wells Fargo. And real quick, I will point out, this is a very close replication of Warren Buffett's Berkshire. Half of his total portfolio is holding Apple, Bank of America, and Wells Fargo. So that represents almost half of our total portfolio. Now, I would argue that he has stayed out of Microsoft, even though one of his best friends and bridge players is Bill Gates, purely just as a personal choice. And Microsoft is, again, our largest position in this portfolio, as well as the largest position in the S&P 500 SPY ETF. Now, the first time you do start following the diamond trade alerts, you're going to skip the step A in our trade alerts. And that's because you won't have written a covered call yet. So the first step for you would, if you're just starting out, would be to purchase the stocks and then immediately go and write the covered call. Now, our product does not rely on stocks going up in value to generate profits. In fact, this is a terrible environment for anyone to count on a buy and hold strategy to try to generate returns. There's a lot of risks that are clearly ahead of us. And so you really want to only own these stocks if you follow the covered call. And so we're primarily writing in the money covered calls, which I will do some examples for in a minute so you can see how those work. But at the end of the day, all you really need to know is that if the market goes up, we have a guaranteed profit in our trades. If the market goes flat, we have a very similar but even greater profit guaranteed in our trades. And if the market goes down, we are covered all the way to the strike price that we sell our covered call. So at the end of the day, we typically will make less when the market goes higher, but when the market goes flat or down, everyone else is losing and we're still making a very similar return week after week. Okay, now we're looking at our Wednesday trade alert from last week. We had a pretty sizable profit. And again, this is when the volatility index had spiked. So our so-called rent that we earned from lending out our shares to stock speculators had actually quadrupled from just a few weeks prior. So that's very good for us when volatility spikes. And that's how we've been consistently pulling in around $1,000 each period on this program. Now, during this week, it was a little bit higher. We had a $1,800 profit from Monday through Wednesday, which we've taken the 2 screenshots. And again, this is before we've written a new covered call and after we've covered the previous week's covered call. And so you can see it clearly writes out the steps. The first step is always to buy to close. You don't have to worry about what price you're going to get. It's all relative to the current price of the SPY. And because we're following the same expirations and the same strikes, we're all going to get very similar returns. Now, the first time you jump into this program, again, you don't want to buy the SPY and just hold it. Our strategy relies on selling a covered call to protect your assets and generate the profit from taking money out of the options market. Now, this year has been very generous to call option buyers as we had the fastest return in the S&P 500 in all of history this year. So most likely that kind of trend won't remain. And the rest of the year, we may see that most people are losing money while we're making our same boring return with a strong safety net under our portfolio. Now, you might be wondering, how do we go about choosing our strike prices? And it's not magic. We're really looking at where Wall Street is putting its capital. So the US stock market has hundreds of billions of dollars trading in and out of it every day. And so if we look at where Wall Street is placing its bets and really just kind of be a parasite on top of Wall Street, it puts us in a situation where we're basically copycatting what the big banks are doing with their own capital. So on the typical option chain, there's 2 things to look at. And so I'll zoom in here so we can do a quick lesson on this. The puts are on the right side and the calls are on the left. And so in general, the open interest on the put side is going to be your support, whereas on the call side, it's going to be your resistance. So if we see that there are a large number of open interest at the 287 strike, this is where big players are going to have to sell their shares if the SPY travels to 287, creating a resistance level. On the opposite side, when people write put options, this is where they would have to purchase the SPY. And so this is where we chose the 280 strike. And this week it flew all the way down to, or rather, we'll get to Friday's trade, but we were sitting in a predicament last Friday. Let's go to the next trade here. So you can see we've been writing this 280 strike pretty consistently. And this is an in the money covered call. And if I pull up the SPY, you can see we had a tremendous move from 288 all the way down to 283, only to pop back up to 285. And so this covered call protected our capital all the way to $280. So during all of this volatility, our account has been bulletproof in all 3 portfolios. there's been very few instances during the entire course of issuing this series of trades for the past 6 months where we've even been down a penny. Now, there was a moment where the S&P 500 crashed by about 5%, and our portfolio showed a small 1% loss. So about 1/5 of the losses that the market had given participants were actually realized in our account. But I told everyone, don't worry, that is the best news in the world because rent has just quadrupled. And so last week we've been making 4 times the potential profit with a very safe in the money covered call. Now that the volatility has dropped, we're having to take on larger risks. So we'll look at the most recent trade that was, of course, much riskier, but actually has nailed it. So we'll take a look at that in a second. Real quick, let's take a look at the Thursday alert. The Thursday program is once again our whale club, and anybody on a free trial who does upgrade to the basic program, we're giving you both the diamond and the whale program free for 30 days. And that way, at the end of 30 days, you can decide what makes the most sense for me. Do I want to trade the SPY Monday, Wednesday, Friday? Do I want to trade the inexpensive diamond stocks Tuesdays? Or do I want to play it really safe with the whale program? In the whale program, you could be following the TLT and the TBT trades with much less than $1 million. But where you're going to miss out is when we do rotate into the equities, where you're going to need $110,000 to have 100 shares of Google, and currently $191,000 to have 100 shares of Amazon. So here's a look at our very boring whale club trade alert. We've been writing this 126.50 call option over and over and over again. And that's because the bond market is signaling that the Fed needs to drop rates. So we have a very odd argument in the bond market and equities market, where one is saying that rates should rise and the other is saying that rates should lower. And this is due to a huge flood of capital looking at the US as the strong place to invest right now during this trade war. Okay, so we're moving now to our Friday trade from last week. And this is a great example of how you can protect your capital and generate a profit. So I want you to notice here that when we wrote this covered call, the SPY was trading at 287.12. And we agreed to sell our shares for $280 for a credit of $7.16. So this was clearly predicting a downturn in the market from Friday to Monday. And the spread on this was actually only about 5 cents. So if we were wrong and we were assigned, we would only make $5 a contract. But that was not the case. And so what happened was we actually had a pretty strong pullback. So let's look at the trade on Monday. Now, this is a unusual screenshot because this is actually after I added the new covered call to the position. And so what we did is we took advantage of the volatility spike. So what happened was, let's pull up that chart. So we wrote this covered call when everything was looking gravy at the 288 level, and wrote this very deep in the money covered call. And sure enough, later in the day, the market started to break down. And by Monday morning, we were trading all the way to 283. And so you can see the trade had generated a pretty sizable profit on the covered call side, which I will line up for us so we can compare. And so we actually had sold the 285 covered call. And so this was when it was trading at 287.17. So we had $2.79 of protection from Friday through Monday. And on Monday, we were able to buy back that covered call for 72 cents. So we collected $2.79. And come Monday, we were able to purchase back the covered call for only 72 cents. And then we went on to sell the 287 covered call. Now this is when the SPY was trading at 285. So this is a totally different profile of a trade. And because we had just caught a big volatility spike and a gap down in the prices, the stock market was betting that the volatility would slow down and that we would get a rally. And so that's when we wrote the 287 covered call to collect 80 cents. Now this one is when the SPY was trading at 285. So this is a situation where we can get what I call a double payday. This is where the SPY can travel higher. We'll get to realize the profits of up to $2 total in this position, plus potentially get to keep the entire covered call credit of 80 cents. So this is a situation where we can make a lot more than $50 a contract and potentially up to $280 per contract. And so again, the math on that was the SPY is trading at 285. We're agreeing to sell our shares for 287, and a stock speculator is willing to pay us $80 a contract. So he's only making money if this travels above 287 plus his premium of 80 cents. So that stock speculator will really do well if this travels towards 288. And again, we have no risk to lose money if the stock market goes higher from there. And so right now, we're currently trading at 286.50. So from last week's trade, we've traveled up $1.50, where we will get to keep almost all of that profit. And let's just see what we'd be able to buy that position back for right now. So you can see we could realize the $1.50 times 100 shares, $150 per lot. Plus, we could buy back that covered call for less than we collected right now. So right now, this trade from Monday is currently up around $170 a contract. Now that's much more than we normally go for, and is enough to more than double your portfolio with that type of return. So we're not going for that normally. But this is probably going to be one of our most profitable trading periods of the entire year. And that's because we were able to accurately predict a pullback from Friday to Monday, protect our capital with the in-the-money covered call, and then predict that the market would rebound by selling the out-of-the-money covered call. And so this has worked out very nicely. And as long as we continue to trade above 285 between now and tomorrow, again, this will most likely be one of our most profitable trades of the year. Moving on to today's trade alert. We were able to basically break even last week on this portfolio. We had predicted a downturn. So not last week to this week, but the previous week before that. And so we had been very protected within the money covered calls. But on the Tuesday, it jumped up. The market started to rebound. So we just broke even the previous week. From last week to this week, we were a little more bullish. So we were able to sidestep the 5% pullback in the S&P 500 without a scratch. Yeah, I think we made about $100 last week, so a very small profit. This week we made a $853 profit, and we did it with a huge amount of cushion and protection with a very defensive set of trades. And so we can go look at those trades right here. We had protection at Microsoft down to 123. At this point in time, it was 127 when we covered it. We had protection on Apple down to 180. It's trading at 187 when we covered it. And so again, if the ETF is trading above our strike price, that means the baked into the cake profit is being realized when we cover that position. So even if we have to cover our covered call for a loss, that's good. That means we are able to hold on to a security that has gone up in value. So the only time we take a loss on our covered call is when we're holding on to our security for a greater profit. Really, the concern is when we have 100% profit on our covered call because the underlying asset may have decreased in value. So the main thing you need to know is whatever strike we sell our covered call at, that's where we're protected to, and we'll make the similar return no matter which direction the market goes. Today's trades were a little less defensive. There's now a 90-day extension on the Huawei ban that has created a huge relief rally today. And so I think the markets are going to travel higher as we see how this all works out. Cold wars can take decades to work themselves out, not weeks, not months, not even years. So trying to jump the gun and predict a stock crash is a very dangerous thing. We have to be positioned to have a safety net and to have the right hedges in place because when it does happen, it will most likely be very unexpected and sudden. So today's trades were primarily in the money, covered calls on Microsoft with $2 of protection plus the 325 in the premium. So really it's the option premium is our level of protection on each of these trades. So we have $3.25 of protection on Microsoft, $11 of protection on Apple, $6 of protection on Facebook, $1.50 on Intel. And you can see we get a little more bullish on the bottom section. Cisco only has 85 cents of protection. Comcast has $1.98. And then we got very bullish on the lagging part of the stock sector, which is the banks. So Bank of America, we can actually realize close to $1 of profit per share with that covered call. And on Wells Fargo, we're set up to also earn about $1.20 of profit per share between now and next Tuesday. So we're taking a little more risk on the Cisco, which is related to the 5G build out, which is this big trade war is really revolving around. And then we're still looking for this rebound in the banks, which is being bet on heavily in the options market by Wall Street. So all of these have a baked into the cake profit. The way to understand the baked into the cake profit is pretty easy. If I zoom in here, you can see on Microsoft, for example, we're agreeing to a $2.21 loss per share if the option buyer exercises his right to buy our shares for $1.25. Now, if he does exercise his right, we get to keep the $3.25. So that is about a spread of $1. So we can earn around $1 per share or $100 a contract on this trade if the stock goes higher and they exercise their right. Now, if the shares just go flat, slightly up or slightly down, we will make very close to that same return, but potentially a little bit more. Another important thing to note is that when the asset is going down in value, the call option premium is going up. So the minute we cover that position, there may be a little bit of premium built into that purchase price to buy it back. So we may, in this very moment of covering it, see a little bit less of a profit than if the stock had gone up. But the second we write that new covered call, we're now collecting a higher premium rate with more time to generate the profits. So that's something we can look at the next time we actually get to cover these in a down market. So far, we've had our positions have volatility in the middle of the week and actually a day before we were going to cover it. but we've never actually had to cover it on a day when the market was down, which is good. Nobody wants to have to be worrying about their portfolio, but I'll make sure to make that very clear when that does happen. So we may have made a little bit less than our baked into the cake profit if volatility has spiked the day of covering, but that's good news because now we get to write a new covered call with 10 days of option premium at the higher volatility. So a little more advanced on that to understand all that, but in general, the higher the volatility goes on the VIX, the better. And you can see volatility is just getting hammered. So we took advantage of this. Let me zoom out a little bit more. So for the whale program, this is about $10 short at a minimum of where I would look to enter equities for that product. For the diamond and basic program, they've just been cleaning up over the past basically 2 weeks when volatility has been at these high levels. So the higher the VIX goes, the better for our program. It allows us to write deeper in the money covered calls with a bigger baked into the cake profit. And also, you know, for portfolio builders standpoint, a lot of people don't go to the doctor to prevent disease or sickness. They wait till they're sick to go to the doctor. So you folks are very smart. You have realized there's a big risk in the market. You realized you can't count on the stocks to keep going up forever, and that you need a safer and smarter way to generate profits. And so this is a method that allows us to pull profits out of the option market regardless of direction of the stocks. Now, if it keeps going up, that's great. We will make a very nice return and have very little volatility, and we'll really be fighting the fear of missing out. But if anything else happens, if stocks go flat, they bobble around, or they crash, our portfolio really shines. And this is when everybody will be running to the doctor as they feel the pain and they're looking for a better way to generate retirement income. So let's take a look at what we're expecting to do tomorrow in our basic program now. And let's also just take a look at this VIX one more time. So one of the favorite trades on Wall Street is to wait for the VIX to spike and then basically to bet that the world's not going to end yet. And so when they do this, there's a huge amount of capital that relies on shorting the VIX every time it spikes. And so we got that quick spike with the Trump tweet warning about the tariffs rising. Caused a little bit of volatility, caused some people to sell their shares, and now the big money is pounding it down, down, down. And so my expectation is we will pound it back down to that 12 to 14 range before we see any more spikes. So that has been what we've been playing it in our portfolio. That's why we sold the out of the money covered call at the 287. And this is setting us up for most likely our biggest return this year in the basic program. And that's because we sold the out of the money covered call and we're able to realize a big return on the underlying asset. So tomorrow, the action will be to buy to close the May 22 287 call option. Now, if the SPY is trading above 287, we're probably going to have to buy that covered call back for a loss. But if we go back to that trade alert from yesterday, when we wrote this, it was trading at 285. So we're already sitting on $150 profit per 100 shares just from this current move. And right now we can buy that covered call back for a profit as well. Another 11 cents per share, $11 per contract. So this is working out very well. And most likely we will write another covered call that is out of the money, probably a couple dollars above the current trading price tomorrow. So that's the most likely set of trades we're going to be issuing tomorrow. And now let me pull up our current hedge. So there is an analyst I like to look at for primarily trying to predict what price the SPY would trade to that would create a lot of automated selling from a lot of different automated trading systems out there. And right now that level's at 264. If the SPY were to break through 264, there would potentially be an avalanche of selling. And so while we can protect ourselves for a few dollars from Monday to Wednesday and Wednesday to Friday, we can also issue emergency trade alerts on Tuesday to Thursday. So if we do start to get a pullback, the value of the covered call will quickly drop, which means we can cover it for very cheap and move the strike lower and lower. So that's our first line of defense. But right now in our SPY program, we're also recommending a small position in this hedge, which we're not currently issuing in our Diamond program or our Whale program. And that is the July 19th, 264 put option, which only costs $1.63 right now per contract, or $163. So that represents less than 1% of the value of your SPY ETF. So per 100 shares of the SPY, we're currently recommending owning one of these hedges. And so this will be a position that we will cover for a loss and then extend the expiration as we get closer and closer to the expiration. As long as we have a trade war threat, this is something we really need to protect our assets. So we're happy to give up about 1% of profits every 3 months with this trade, which will cover us in case of an immense crash in the SPY. And so this can quickly jump to $10 to $20 in cost for the put option writer to buy this back from us if we travel and go below that 264 level. So not only will we benefit from the volatility spiking and the option premium escalating during a pullback with our covered call strategy, this small 1% position could potentially generate anywhere from 5 to 10% total portfolio gain in the event of a massive flash crash. So while we're writing these covered calls every 48 hours and have a lot of protection from the normal movements in the market that are somewhat easy to predict, if we do get a sort of nuclear sell-off, that's where this tiny little position that we will be continuing to hold will really save our portfolio from any type of drawdown. So that is kind of what we've got lined up for you guys this week. Let me just pull up the TLT. So you can see in our Whale program, everything American's doing very well right now. The TLT has been climbing higher, as has the SPY. So just really a different sort of mindset with the Whale program. You know, this has only gone up. If I flatten this out, it looks like it's going straight up when I have it like that, but it's really not going that quickly up. So if we do draw it out, you can see the TLT makes for a great covered call product because there's such little volatility. The central banks are all trying to control the rates of their bonds, and so it makes it somewhat of a boring but consistent way to play the markets right now until we do catch a big volatility spike. So again, that Whale program is going to need a much bigger magnitude of a spike before it would jump into it. So right here, if we see it get towards the December levels with a $30 VIX, that's when we'll happily jump into the core positions of the Whale program. We'll be buying these stocks as they're crashing, and we'll be able to write super deep into the money covered calls where we're essentially predicting a bottom is near and then start to generate the extreme income from call option prices really skyrocketing during that type of a move. All right, so let's go ahead and open it up for questions now. Okay, so someone wrote, not to get ahead, but are you going to roll up the call for Friday a day early on the SPY? No. So the only time I would do anything a day early on the SPY would be in the opposite direction. So if the SPY were crashing, our program again is much more concerned about losing money than it is making money. So in this example, we're completely protected. We have a huge cushion, and there's really no reason to take any action right now unless we were trying to be greedy. So if we thought the SPY was going to jump up even more from today to tomorrow, we might want to buy that back today and push the strike higher. But from my mindset, that's not worth issuing what I call emergency trade alert on the Tuesdays or Thursdays. Now, if the value of that covered call had lost value and we could buy it back for super cheap, that would mean the SPY was traveling lower, and we're going to want to lower our strike price below the trading price. So because we're small traders and we can get easily filled, we're really going with the flow of the market. We're following the momentum. So when the market's going down, we're going to predict it's going to keep going down. And when the market's going up, we'll essentially just continue to move with the market on Monday, Wednesday, Friday. Okay, Fred has a question. Any idea why Robinhood does not show the list of current day options? For example, tomorrow they will drop the 522 list and only show 424 and later. I have not been able to get an answer from them. You know what, Fred? I will personally try to reach out to them this week and develop a relationship because that is our goal. We really want to partner with Robinhood because they pay for all the fees related to this. So just for everybody listening, let me show you their website. There's a few brokers I really recommend. For a cash account, Robinhood's the best. Not only can you do these trades on the go from your phone and have them pay for every fee, they're the fastest growing broker dealer in the world. They're valued at $5 billion. They're owned by Silicon Valley private equity, and they're paying for every little fee involved, from options assignment to options contracts to everything. And they have access to our cryptocurrency portfolio. So in every email, there's a link. If you click it, they'll give you a free stock when you join, and they'll give us a free stock. They do not accept 401ks, and we have quite a few people signing up now. So I do believe I can get our members premium support and get a better line of communication with them. And I have managed to do that with other brokers we've been recommending in the past. If you have a 401k or would like a better support, Interactive Brokers is probably the second best choice. They've been in business a long time and they have extremely cheap fees. So that's a good option there. Okay, I've got another question. What protection for the Diamond program will you implement for a crash? So currently we are playing, so that's a good question. So for these stocks to crash, there's a few things that really need to happen. They are the leaders of the S&P 500. They're the most profitable companies. Most of them have somewhat of a monopoly on their industry, and they have the best credit ratings. They have almost unlimited capital to do whatever they want. And so what's going to cause them to really crash? Well, probably the credit market has to crack. They have to stop being able to have free access to capital, which will most likely happen when their growth and profits start to deteriorate. So there's a few things that we can look at to try to predict that happening. And so one would be for weaker markets to crack first, which might be the high yield credit market. So one hedge we have is the SJB. We're not using that yet. Right now, the credit markets are very strong. And so we're not seeing that breakdown yet. And again, with crashes, when I'm going to put on a position that can lose money if I'm wrong, I'm going to join the momentum as it's happening. I'm not going to predict it happens before it does. Now, the opposite is true with the covered call strategy. We can predict a crash in the underlying assets by writing an in-the-money covered call. And if we're wrong, we make money. And that's what we've been doing all year. We've been the negative Nancy predicting pullbacks and making money as we were wrong all year long. If I'm going to predict a crash, it has to actually be starting to unfold. So we have a few options. There will be really just two that I will recommend to this portfolio. One would be looking at the SJB ETF, which is the short high yield ETF. And again, the second you're wrong on this one, you're going to be losing money very quickly. So we want to see this actually starting to escalate. The only other one that I might do before a crash has actually happened, once we get that VIX really low, will probably be a 3-month QQQ put. So let's just look at, and I'll have to go look at the analysis from Nomura Bank is the one that puts out good analysis at which trigger levels would cause rapid sell-offs. So in the basic program, we're using that 264 put on the SPY. For the diamond program, we're a little more allocated towards tech. So we want to use the QQQ to protect against a downturn. So probably somewhere around a 270 to, or rather a 170 to 160 range put option on the QQQ that will have around 3 months of time premium. Will most likely be the hedge we put on with about a 1% total portfolio risk. And I'll most likely put that on a little early once the VIX drops even lower. Now, if we start to see signs that the trade war tensions are going to loosen, we won't be putting that QQQ trade on. So currently, the diamond program is using the covered calls to protect its assets. And Fred, I guess they just don't want you trading intraday options. So maybe they're just trying to prevent people from trading that. Now, have you had a problem being able to cover your positions the day of with the SPY? Is it just that they're not going to let you open a new position intraday? So no, you're able to get out easily? Okay, S. Blair has a question. Do you always place your order at the mid or do you get filled at the market? Okay, so Fred says he's having no problem exiting those positions. He just can't open the intraday. So that must be it. They don't want you over trading, considering they give it all for free. Maybe they're just trying to avoid something of that nature. I'll get a hold of them and get a better line of contact. They're desperate to get large portfolios. While they're the fastest growing brokerage in the world, their biggest problem is it's all millennials who want to use the phone app who only have like $300. So for our business to be bringing in serious account sizes, they're going to treat our clients like gold because it's really the missing piece in their business model and a primary reason we do look forward to trying to become a strong partner for Robinhood. Okay, so Blair, which broker dealer are you using? With Robinhood, you don't have an option. You have to just fill it at market. But again, these are the most active option markets, really of all the, okay, Tastyworks. So yeah, you can always play with the bid and try to get a better fill. So if you don't get filled right away at the mid price, you know, then just lower your asking price a few pennies and sit back and see if it gets filled. I would give any trade you put out at least 5 minutes to get filled. There's so many automated trading systems out there that will look at your order flow then they'll go look for the correlated trades and they'll put those on first. Once they get filled, then they take your order. And they're trying to set themselves up for a risk-free profit. And so that's where the James Simons of the world have averaged, that fund averaged 75% for most of its career of 30 years, 75% annualized return. And it's all with automated trading systems. Recently, they've been averaging 30% a year. So it's just insane. But yeah, if you put these orders out, just be a little patient, wait 5 minutes. If you get filled, great. If not, just lower your asking price a few pennies and then try to get filled. Now in the SPY, there's no point. I mean, the spread's like a penny on most of these, so you might as well just put the market order in. When we're trading something like Intel, Cisco, and Comcast, sure, there's a lot, and even Wells Fargo, there's a lot less volume on those. So the bigger the spread, the more likely you should try to be a little more patient and get close to that mid price or a few cents under. Let's see, any other questions out there today? Try to unmute everybody so we can chat a little bit before we head out.
192.
All right, everybody is unmuted now. A lot of you guys are still self-muted, but
What do you think on California? A week to get the balance? Okay, let me go ahead and put. What do you see Drip Tape going for? You have any idea? I'm sure he's
Kirk, is
throwing
that you talking there? Are you talking to us or are you on the phone? I think Kirk's on another line right now. All right, guys, any other questions out there? You're now unmuted if you want to chat or say anything. How are you doing so far, Fred? You enjoying the program?
Yes, I am. Yes, it's been good. I've missed a few of the entries that you've had, but that was my fault, not yours.
Oh, you know what? We're going to be doing this for years and years to come. So now that you've turned your portfolio into more of a business instead of just a speculation, I think you're going to do really well here.
I believe you're right.
Oh, there's Dean. You out there, Dean?
Yep.
All right, let me throw up Dean's phone number there in case anybody wants to give him a call. We got mostly members on here, but there are definitely some free trials on there.
Okay, perfect. Yeah, if you're out there and you're not upgraded yet, please feel free to give me a call. That phone number is 505-322-7515. Oh, there it is.
Yeah, if anybody, if you're on a free trial right now and you do want to try out either the Diamond or Whale program, that's the big carrot on the stick to get you to upgrade because you get 30 days free in those programs. And if you're already a basic member, and you should already be getting that. If you're not, let us know and we'll make sure you do get that during your trial period. And yeah, another great webinar, a great audience. Probably a record-breaking profit on our basic program, which is nice. Although, you know, record-breaking for us is, I don't know, 50 basis points, so nothing too crazy. Okay, S. Blair says, what is your background experience in trading? Okay, great question. So my experience started off in 2008. I didn't even know who Goldman Sachs was or anything. I had started a few companies, done very well at a very early age, and was basically the guy people would come to try to increase their company's profits. And I had this funny fellow fly into my office who had shorted the stock market, buying very far out of the money put options on the SPY and the QQQ. And he was certain, he's telling me he had inside friends in the military and the government, and that the stock crash wasn't going to stop, and that these 30,000% returns he had pulled off were going to continue. And so, my first step into stocks was, I think I put 30 grand into a put option at the end of 08. And of course, if I'd done the exact opposite, I would have done very well. We went on to start selling his program, and within about a year, I realized that this guy only had one bet at all times, no matter what, and that was down. And so from there, after seeing how fun this sort of business was, and always being very interested in money, since I think even as a third grader, I was playing with all the currencies. My mom was a travel agent, owned a travel agency, so we were getting flown around the world to see all these resorts they wanted her to sell. But yeah, I was very interested in finance as a young kid and had a pretty rough introduction to stocks in 08. And after that, I decided, you know what, I need to find some better qualified people to sell this sort of information. And instead of building other people's businesses, well, hey, let's start building our own. And so that's when we got into this industry. And so for the next 5 years, I really focused on finding the most credible people out there to sell. And we did that. We sold everybody under the sun. Really anybody with any sort of pedigree or credentials who had a long track record of doing well became our client. And we had a huge waiting list of people who wanted us to sell their information. So during that period, I studied finance inside out, studied all our product content. And the big thing I noticed was that all of them thought they needed to outperform the market to provide value. And so, it was a bull market. A lot of them did, but here's the problem. Most people following their programs, number one, they couldn't understand them. Number two, the trade alerts were totally unpredictable. Not only did you not know what you're going to trade, you didn't know when you're going to trade it, nor did you know how much capital to allocate it to those trades. So after seeing this year after year after year, I gradually got to the point where I started creating my own products. For a few years, I had traded about once a month. We had a program that would scan OTC stocks and look for huge volume pumping through them. And we had a very, very popular product for about 2 years that I delivered, where we were just scalping penny stocks. It was pretty fun, pretty insane. We had some 1,000 people following that program. And after the Obama regulators came in, they wiped out the whole penny stock market, so that came to an end. But that was one fun period for me. And then after reflecting on that, took a few years off. My mother actually became sick with cancer, so took a few years off to take care of her. Came back late in the game, just about a year ago, and asked myself, what do people really need? Not what do they want, but what do they need? When I realized that all of these hedge funds out there, all these advisory services, they couldn't even beat the SPY ETF. In fact, almost no one can. That's when I realized what people need is not necessarily to beat the market. They need to learn how to play it safe and become the market. And so that's when I came up with the idea of this product. How do we take the risk out of people's portfolios and create something that's sustainable into retirement, that's easy to follow and very passive? So sure, I've read 1 million books on finance. I watch 18 hours a day of content. But at the end of the day, what we're trying to do for you is not make market predictions. And that's a big difference in terms of what we're doing compared to most. Instead, how can we turn your portfolio more into a business? And that's what we're doing here. We're buying the asset that everybody wishes they could purchase but don't have enough capital for. And then we're letting them borrow it. So we're turning your portfolio into an investment bank. And instead of lending out dollars, you're lending out shares. So at the end of the day, we're going to take some of the pain out of the market with these in the money covered calls. We're going to give up some of the profits that the SPY will enjoy during bullish moves in the market. And at the end result, you're going to have a nice consistent return with very low volatility. And we're doing it by trading the most popular securities in the world. And I also have the hedge fund license at one point, so I do have all the jazz for that. But rather than manage people's money and charge 20% and 2% management fee, which I had considered, I like this a lot better. You manage your own trades. We'll teach you how to get them filled for free with Robinhood or Interactive Brokers almost for free, and teach you how to take control, how to protect your assets and generate a safe return. Any other last questions out there, guys? Well, another great webinar. We ran for about an hour and 10 minutes. Hope everybody can make it back next Thursday. Okay, wait, we got a question. What is a reasonable expected return for me, a retiree? Gary, good question. So the profits we've been generating while the VIX was at a higher level has been to the tune of 50 to 100% annualized, which is insane. I'll tell you right off the bat, I don't want to generate that kind of annualized return. So if we do, that's great. And even though we've had these high volatility levels, we've been playing it super safe with in the money covered calls. In general, our real goal is to generate around 1 to 2% max per month with a huge safety net. Now, will we sometimes over deliver? Sometimes, but that's not going to be the premise of this strategy. Active Trader 247, is this great webinar available as YouTube to share with potential customers? It sure is. And if you'd also be interested in joining our affiliate program, let us know. We can get you set up there. So yeah, we will automatically send you a copy of this recording via text message and email. And please feel free to share our content. You know, this is it's a cool product. In 10 years of doing this, I've never seen anything at all like it. In fact, if I could travel back in time and tell myself this is the product you need to develop, I would roll over and laugh at myself, because for the last decade we were so focused on trying to make the big gains and outperform the market, when what you really need to do is just become the market, become the casino, and pull that easy profit out of the option market and play it safe. All right, gentlemen, thank you so much. New trade alert tomorrow. As long as the stocks stay around where they're at, we'll have a record return on the basic program this period. And that's it. So thanks again.